Ever wondered why understanding different types of exchange rates matters? Well, it's simple. Exchange rates are the backbone of the global financial system. They dictate how businesses, governments, and even individuals conduct cross-border transactions. In this whirlwind of global finance, there are three types of rates that are particularly important: the spot rate, the term rate, and the cash rate. The spot rate is the current market rate at which one currency can be exchanged for another for immediate delivery and settlement. The term rate, short for tomorrow, is an exchange rate used for transactions that are settled the next business day. Lastly, the cash rate is the interest rate at which banks lend to or borrow from each other on an overnight basis. Each of these rates plays a unique role, and understanding them can help you navigate the complex world of international finance. Dive in with us as we explore each of these rates in detail. First up, we have the spot rate. Let's dive into what that means. The spot rate, also known as the spot exchange rate, is the current market rate at which one currency can be exchanged for another currency for immediate delivery and settlement. It's the rate you're dealing with when currencies are traded in the spot market, where transactions are settled swiftly, typically within 2 business days. Spot rates come into play for immediate transactions like buying foreign currency for a vacation or settling international trade transactions that require immediate delivery of funds. So, that's the spot rate. Now, let's move on to the term rate. Now, we move on to the term rate. This term is shorthand for tomorrow. The term rate, also called the term tomorrow, next rate, is an exchange rate used for transactions that are settled the next business day. Term rates are commonly employed for transactions necessitating delivery and settlement of funds on the following business day. They enable market participants to forge contracts today for currency exchange at a specified rate tomorrow. That covers the term rate. Lastly, we'll explore the cash rate. Now we delve into the cash rate. Picture this is the interest rate at which banks lend to or borrow from each other overnight in the money market. Essentially, it's the cost of borrowing or the profit from lending funds for very short periods, typically just overnight. Now, this cash rate isn't just idle chatter among banks. It plays a pivotal role in shaping monetary policy and influences short-term interest rates in our broader economy. Central banks use changes in the cash rate to manage key monetary policy objectives like controlling inflation or stimulating economic growth. And that sums up the cash rate. Now, what makes these rates different and why are they important? Let's break it down. Spot rates are for immediate settlement, term rates settle the next business day, and cash rates are overnight rates in the interbank market. Spot transactions settle within 2 business days, term transactions settle the next business day, and cash transactions settle overnight. Spot rates handle immediate transactions, while term rates are for transactions settling the next day. Cash rates, they determine short-term borrowing and lending rates between banks. That's a wrap on exchange rates. Remember, understanding these rates could be your key to navigating the foreign exchange market. That's our deep dive into exchange rates. We've unpacked the spot, term, and cash rates and their unique roles in the financial world. Remember, understanding these rates can empower your financial decisions. Subscribe to our YouTube channel for more insightful videos. Keep learning, keep growing.